Hey everyone, and welcome to Dirty Money, and we have an action-packed podcast for you today. How you doing, Mike?
Doing pretty good. It's one of those weeks where you have uh, history written, and it's gone very, very fast this week from the start to the end. I can't believe everything that's taken place with banks and
It
what's
has.
going on with the
Yeah.
Feds, what's going on with inflation. Where are we going to go? I mean, well, it's going to be packed.
Well, yeah, so the most recent thing, and I think the most timely to talk about, the Fed has now hit a new record high on loans to banks. So, according to their report yesterday, they have $153 billion loaned out in what's called the discount window, Fed's discount window, which is a loan facility to banks. Then they have, and that's a record. So in 2008, the previous high, financial crisis 2008, this loan facility, the discount window, it was at 111 billion. Now, if you adjust it for inflation, um, it's about the same. Okay, so 111 billion is 2008 is 155 billion today. The current record at the moment is 153 billion. So basically, we're at the same level as 2008 in loans to banks if you adjust for inflation. They also have 143 billion to insure the assets of Silicon Valley Bank and Signature Bank through the FDIC. And they have this new funding program, the Bank Term Funding Program, which just started like a couple of weeks ago. And basically, what this program is where they will loan banks money according to their collateral. So if banks have, for example, treasuries that they can't sell because if they sold them, they would, not get the original rate they bought them for, which is basically what happened to Silicon Valley Bank, why they lost $1.8 billion in their treasury sale. Basically, banks can now borrow money from the Fed at low interest according to their collateral, to the amount of treasuries they have. And that basically is to avoid a fire sale of treasuries, as banks, there's a run on a bank and it forces them to sell all their treasuries at a loss in order to give depositors their money. They can now borrow money from the Fed according to the amount of treasury securities they hold, which it's kind of like a get out of jail free card for the banks. But right now, this funding program, $11.9 billion has been borrowed so far, and $16.9 billion worth of collateral has been pledged by banks. And JP Morgan Chase thinks that this program could inject as much as $2 trillion into the economy through these loans to banks.
I mean, that in and of itself is kind of mind blowing. So we're going to go buy treasury notes. We're going to use them as collateral to get credit from
The Fed.
the same notes that we just bought, essentially in the same exact system. So that's
Yeah.
like it's just mind blowing that it's the craziest circle. Is money even real anymore? Like, how does that work? So let's say JP Morgan has $200 billion in treasury notes, which I wouldn't be surprised if they held something like that right now, right? So now JP Morgan buys the 200 billion, gives them the money. They can then get the 200 billion back on their books immediately and still maintain the asset on their whole system. What stops anybody from being frivolous at this point with what they're loaning their money for? This just How did SVB not know about it, first of all? And
Well,
did
it was developed after SVB. So in response to that, it's a new program that has been developed because of that.
and then the other question is do you have to be a US bank to do this, or can you be a world bank and do it?
I believe I believe it's only for US banks. Although, well, if you hold US Treasuries, I don't know what the requirement is.
Yeah,
So
that's what I mean. So, like,
yeah,
are they still figuring out the requirements for this? How deep does the rabbit hole really go when you're talking about lending money on collateral that you purchased from the same place? I mean, is there any limit to the amount of money that the governments are going to start printing right now? It doesn't
it's
make
pretty
any sense.
insane. Yeah, it's pretty insane. I mean, yeah, so far, like JP Morgan Chase, they estimated it could be up to $2 trillion that it's basically printed through this program. Their lower estimate was about like 460 billion, something like that. But yeah, it's it's pretty crazy, and it just shows that basically the economy is not really based on real money. As soon as you take out the all the money that's been injected into the economy, you start having, you know, incredible destabilization. You have to start pumping money back into it again. So um
I mean,
obviously for yeah.
I just want to figure out how many U.S. Treasury notes are purchased annually, right? What's the total amount? You know, of what's the trading volume for U.S. Treasury? So trading volume as of February for the year was $650 billion.
In
That's
treasury bills or in all types of
all
treasuries?
types of treasuries.
All types.
Yeah. So the outstanding is 24 trillion.
Yeah.
Let me be clear on that. There's $24 trillion in treasury notes that are outstanding.
Well, that's our government debt, isn't it?
Yeah, that is our
Yeah.
government debt, and that's exactly what we're playing with
Well,
now.
part of it, because it's like
Yeah,
30 trillion now, but part of the
yeah.
government debt is those.
Part of the government debt
Yeah.
are these treasury notes, and because that's how we keep it up. So now we're gonna lend money from the Federal Reserve based on the amount of notes you hold.
Yeah, I mean, I guess it's the same idea that you know, rich people use in private banking, where they put their own money into a bank and earn interest on it, and then the bank lends their own money to themselves, and you know, they borrow money for themselves so that they don't have to pay tax on it because they're not withdrawing actual capital
Yeah.
from the bank. So it's kind of a similar deal, isn't it? A bank stores the wealth and then loans back that money from the Fed. It's kind of a similar.
I guess it's the same in a sense, but ultimately you're opening the floodgates to complete collapse. Is, is
Yeah.
what you're
Well,
what you're doing right now is you're turning around and saying that whatever treasury notes, yearly notes, bonds you're going to hold, we are willing to loan you the money for those notes, even if they are not satisfied. Who's going to satisfy those notes? The same people lending you the money.
yeah.
So
I mean, the idea is so that they can hold them to maturity, so that they get the original face value back. Because otherwise, what happened with SVB is what they had to sell them at a loss because they were selling them before they matured, right? And that the price on the open market had changed because they were paying less interest because the Fed had raised rates. So the Fed caused the problem. So trying to solve the inflation problem, the Fed caused this problem with SVB, and now they're using another method to solve this problem, which is going to probably cause more inflation because they're pumping more money into the economy.
and inflation's a whole nother subject. We could talk about that in a second, but I just want to really have people understand how this works, like just fundamentally. Your grandfather gives you a piece of gold and you're going to hang on to it for 5 years, and in 5 years he's going to give you back the money that you lent him for the gold. But he's now gonna once he gives you that piece of gold and the money that you gave him to hold the gold, he's gonna give it back to you within 10 minutes of you giving him the money for the gold. That's the best way to explain this. I give
Yeah.
you gold, you give me gold, I give you money to hold on to. I'm supposed to give you the gold back in 5 years. You give me the money with a little bit of interest. But now you're gonna give me the gold, I'm gonna give you the money, you're gonna give me the money back. What's
And
the
then I'm going
point?
to give you back the gold. Yeah.
There's just no point.
Yeah.
Just give them the money. Just start printing money again. It's over.
Yeah.
It's mind blowing that this is their solution.
Well, I think it's just basically just trying to hang on. I mean, the whole thing's kind of going down. I have that opinion now that we are entering a really serious financial crisis that is going to be much bigger than 2008. And
2008 is gonna. I don't
yeah,
know. I don't want to scare people, but 2008 is going to be nothing compared to what they're going to
yeah.
be doing. I don't know when this is going to take place. I don't know when the bottom's going to fall out. Maybe there's going to be 10 years where we can still make money. Maybe somehow there's end in sight, but they're really doing everything they can to shore up what happens in the next 90 days. And they're not even thinking about what's happening in the next 900.
Yeah.
Right. So
And
they have to do something now. but there has to be a correction into the banking system. And really, that correction should be an economic one that naturally takes place between the macro scale and the economics. That's where it really is going to be fixed fundamentally. If we still trying to micro each individual bank, and we're trying to set up these new systems, these new term banking, or we're using treasury collateral to loan money so that they can balance their books at the end of the night, all we're doing is just pumping more stuff into the micro side, and it's never going to get fixed. We have to let the markets naturally work their way through it. It's painful. It's going to be painful.
And you've got people like Michael Burry, who, predicted the 2008 crash. He has been saying for several months that a big crash is coming. I think when the market kind of hit its bottom earlier this year, it would have been last year actually, hit a bottom, he still said 50% more to go. And so, you've got people who really know what they're talking about, predicting a massive crash, kind of betting against the US economy right now.
Ladies and gentlemen, you have been watching Dirty Money. Please subscribe to the channel if you're new. We'll see you in the next video.